If you've been paying attention to Warren Buffett's recent moves, you might be scratching your head a bit. On one hand, he's buying up investments in businesses that have hit a 3-year low, doubling down on companies that some investors have written off. On the other hand, he's selling off billions of dollars in Apple stock, one of his biggest and most iconic success stories. For everyday investors, it's a tricky puzzle. How do you make sense of these moves when the market itself feels so unpredictable? Should you follow his lead? Take a completely different approach? Or is there a bigger picture behind his strategy that we can apply to our own investing decisions? Today, I am breaking it all down. What Buffett's selling, what he's buying, and most importantly, what it all means for you. When it comes to Warren Buffett, there's one thing you need to know. The man plays the long game. Always has and always will. While some investors are out there chasing the next shiny stock, Buffett's sticking to what works, value investing. And what's value investing, you ask? In simple words, it's like shopping at a discount store for high-quality items instead of splurging at a luxury boutique. You're not looking for trendy, you're looking for timeless. At the heart of his strategy is one simple rule. Price is what you pay, value is what you get. Meaning, just because something is expensive doesn't mean it's worth it. Buffett looks for businesses with strong fundamentals. Things like solid earnings, low debt, and competitive advantages, but only if he can get them at a good price. Think of it like buying a Ferrari at a used car price. Now, here's the kicker. Once Buffett buys, he holds. He's not flipping stocks like pancakes. He's patient, waiting years, sometimes decades, for his investments to pay off. Take Coca-Cola, for example. Buffett bought shares back in 1988 and still holds them today. And when it comes to selling, well, that's where it gets interesting. Buffett doesn't just sell because the market's up or down. He sells when the value story changes. Maybe a company's getting too expensive, or its fundamentals are slipping. In his eyes, every dollar invested should be working as hard as possible. If it's not, it's time to relocate. But let's not forget the golden rule, cash is king. Buffett famously likes to keep a big pile of cash on hand. Right now, Berkshire Hathaway is sitting on over $325 billion. Why? Because having cash means he's always ready to pounce when the market offers a deal. Now let's talk about what's leaving Warren Buffett's portfolio, because he's not the kind of investor who lets go of a winner without a very good reason. First on the chopping block is none other than Apple. Yeah, the tech giant that's been one of Buffett's crown jewels for years. Over the past few months, Berkshire Hathaway has reduced its Apple holdings significantly. This has also raised some eyebrows. After all, Apple's been a top performer and still dominates the tech space, so why sell? Well, for starters, Apple's stock price has been on an absolute tear over the years, and some analysts are calling it overvalued. Buffett is cashing in on those gains while they're still ripe. Another reason could be diversification. Apple once made up a huge chunk of Berkshire's portfolio, almost 45%. By trimming that down, Buffett reduces his risk exposure to one single company. Next up is Bank of America. Buffett has been slowly cutting back on his position here, and it's another curious move. Financial stocks like Bank of America are often Buffett's bread and butter. He loves companies that print cash and pay strong dividends. But let's face it, the financial sector isn't exactly a hotbed of growth right now. Unstable interest rates and economic uncertainty is squeezing the margins for big banks. Here's where it gets interesting. These sales aren't just about individual companies, they're about the market as a whole. Buffett doesn't come out and say, "Hey, I think the market's overvalued," but his actions often speak louder than words. Trimming positions in tech and finance, two of the market's heaviest hitters, could be his way of signaling caution. Think about it. Tech stocks have been soaring, and some are trading at sky-high valuations. Meanwhile, the financial sector is dealing with tightening margins and regulatory scrutiny. Buffett is looking at these sectors and thinking, time to lock in some profits and move on. But don't get it twisted. Selling doesn't mean Buffett's hitting the panic button. He's simply reallocating resources. Remember, his goal is to make sure every dollar is working as hard as possible. And if that means saying goodbye to Apple and Bank of America, so be it. Now that we know what Warren's been selling, let's flip the script and talk about what he's been snapping up. And trust me, it's just as intriguing. While tech and finance might not be sparking his interest right now, Buffett's shopping list shows he's got his eyes on entirely different opportunities, ones that also align perfectly with his classic value investing philosophy. Let's start with the big one, Occidental Petroleum. In the past few weeks, Berkshire Hathaway added roughly $405 million worth of Occidental shares, pushing its stake to a staggering 28% of the company. That translates to over $13 billion in Occidental stock. This isn't just a small addition, it's a massive vote of confidence in energy as a long-term play. Occidental stock, down nearly 25% year-to-date, is trading at a price-to-earnings ratio of around 10, making it relatively undervalued compared to other energy giants. So why energy and why Occidental? For one, energy has been on a bit of a roller coaster ride lately. Oil prices have fluctuated, and global energy demand remains unpredictable. But Buffett isn't fazed by short-term swings. Occidental has consistently delivered strong free cash flows, reporting $4.8 billion in free cash flow over the past year alone. In typical Buffett fashion, this isn't about chasing short-term oil price trends. It's about owning a business with strong fundamentals and a leadership team he trusts. Next up is a bit of a curveball, SiriusXM. Berkshire recently bought about 5 million shares of this satellite radio company. If you're scratching your head, you're not alone. SiriusXM has had a rough year, with its stock price dropping over 60%. So what does Buffett see here? Like Occidental, SiriusXM still generates strong cash flows, with an operating cash flow of $1.3 billion in the first 9 months of 2024. Plus, its core business, subscriptions to satellite radio, bring in recurring revenue, which is something Buffett values deeply. Plus, with its strong market position in its niche, SiriusXM has room to innovate and adapt. Last but not least, let's talk about VeriSign. This is not a new position for Buffett. Berkshire has held shares of VeriSign for over a decade. But in the last quarter, Buffett added nearly 234,000 shares worth approximately $45 million. VeriSign isn't flashy. It manages domain name registrations and internet infrastructure, including overseeing .com and .net domains. But what it lacks in glamour, it makes up for in profitability. The company boasts a 60% operating margin and generated $730 million in free cash flow over the past year. These three purchases, Occidental Petroleum, SiriusXM, and VeriSign, might seem unrelated at first glance, but they share common characteristics. Each company operates a sector that isn't getting much love from Wall Street right now. Energy stocks have been volatile, satellite radio is seen as outdated, and infrastructure companies like VeriSign fly under the radar. But Buffett sees these as opportunities, not risks. What ties these investments together is their strong cash flow. Occidental, SiriusXM, and VeriSign collectively generated billions in free cash flow over the past year, providing Berkshire Hathaway with steady income streams. Buffett's strategy here is clear. Buy undervalued companies with reliable earnings and let time do the heavy lifting. Buffett's timing is another critical element. While many investors are skittish about market volatility and macroeconomic uncertainties, Buffett sees this as a buying opportunity. Energy prices have pulled back, tech stocks are dominating headlines, and consumer-facing businesses like SiriusXM are facing challenges. But Buffett isn't buying hype, he's buying bargains. By entering these positions now, he's positioning Berkshire Hathaway for future growth while the rest of the market is focused on today's noise. Let's put these investments into perspective. Together, Buffett has spent over $560 million on just these three companies in the past quarter. Berkshire Hathaway's cash reserves recently topped $325 billion, giving him the flexibility to make these moves without taking undue risks. Now, with Berkshire generating $10 billion in operating income last quarter alone, Buffett has the financial firepower to continue hunting for deals. Buffett's recent purchases signal confidence in overlooked sectors like energy and infrastructure while raising questions about the tech-dominated bull run. By investing in companies with solid cash flows and long-term viability, Buffett is hedging against market froth and focusing on fundamentals. So, what's the takeaway from Warren Buffett's latest chess moves for everyday investors? At first glance, it might seem like he's playing two completely different games of selling and buying at the same time. But when you zoom out, there is a clear method to the madness. Buffett's strategy boils down to two things: selling overvalued assets and buying undervalued opportunities. It's not about predicting the future, it's about responding to what the market is offering right now. And right now, the market is serving up a lot of contrasts. Overheated tech stocks on one side and neglected sectors like energy and infrastructure on the other. When you look at Buffett's sales, Apple, Bank of America, it's clear he's locking in profits. These are great companies, no doubt about it, but even great companies can get too expensive. Selling them isn't about giving up on them, but it's about reallocating resources. On the flip side, his purchases, Occidental, SiriusXM, and Verisign, show a classic Buffett move: finding value where others aren't looking. These companies might not be market favorites right now, but they have strong fundamentals, steady cash flows, and long-term potential. In other words, they're bargains in a market that's otherwise looking pretty pricey. Buffett's recent moves also reveal something about his market outlook. By selling tech and financial stocks, he is signaling caution about sectors that have seen massive growth and could be nearing a peak. By buying energy and infrastructure, he's positioning himself for sectors that are more stable and undervalued. Want to know if the everything bubble is bursting soon? Click the video on the screen.